Hey guys, Chris from Adapt Tuition here, and this is video number 8 in my PoA MCQ prep for the July 2020 CSEC exams. If you've missed any of the previous videos, I'm going to put a card up there and a link in the description below so you can check out that playlist and take a look at all of the previous videos. The questions in this video will focus exclusively on limited liability companies. If you are a bit rusty on that topic and you want to revise a little bit before you jump into these questions, I'm going to put another card up there and a link in the description below so you can check out that playlist and then come back here to proceed with these multiple choice questions. Okay guys, so no long intro today, let's get to those questions. Okay, so question number 1, which of the following is a characteristic of private limited companies? So private limited companies are those companies that do not offer their shares for sale to the general public or on the stock exchange. So let's look for that answer. So, their shares are available for purchase on the stock exchange? Definitely not. Their shares can only be purchased by family members. That's a tempting one, but there are companies who have shareholders who are not family members. You can have private limited companies that are family owned, but not all private limited companies need to be family owned. C, their shares are only available for purchase from a stockbroker. That's not true. You have to go directly to somebody who is a shareholder and they have to clear it with their, other member shareholders, in which case you might not even get to buy a share. Their shares are not available for purchase by the public at large. That is the correct answer. So let's get a little yellow going here. All right. Number 2, what is the name given to the share of profits received by shareholders of a limited company? Well, shareholders get dividends. So let's see, profit share, no. Interest, no. Interest is paid on debentures and loans. Dividends, yeah, that's what we're talking about right there. Capital gains. Now, that is another type of, I don't want to say reward, but it is a benefit a shareholder gets. Let's say you buy a share at $5 and 2 years later it's worth $10. The value of your investment would have increased. That is referred to as capital gains. It's not something you see really at the CSEC level. You might hear about it if you go to Form 6 or further than that with accounting or finance. Number 3. So number 3. There's No More Inc. has declared an ordinary dividend of 10%. If an ordinary shareholder has $5,001 ordinary shares, the amount on the dividend warrant sent to him or her will be, okay, so this term dividend warrant is what shareholders get. They get, and I actually have one here, but I don't want to show it because it has my address and other information on it. But it comes from the company that's issuing dividends. It tells you your shareholding, the value of your shares, the percentage of the dividend, and how much money you get. So to calculate the dividend, you have to find the par value of the shares, which is the total number of shares by the par value per share. In this case, 5,000 by 1, which is $5,000. And then you multiply it by the percentage. 10% of 5,000 is 500. There you go. Right, so just be careful with the calculations. If you need to review, if you have any questions, a lot of you guys have been sending questions. Please continue to send. Just know I can't answer everybody right away. It'll take a little bit of time, but I do love hearing from you guys. Okay, let's go up and go back across now to number 4. So a limited company can raise additional funds by issuing a document under its seal that promises to pay the holder of that document a fixed rate of interest at specified points in time. This type of financial instrument is known as, okay, so it says the company can raise additional funds, which means the company is borrowing money. It's raising more money to finance projects or whatever. And it issues a document under its seal. Now you might be thinking, well, it issues shares. And shares should be under the company. No, the company seal is literally a stamp with a diagram or a picture or an image that represents that is the company's seal, right? They use that because long ago when they used to seal envelopes and make sure nobody opened it, they'd pour some wax. I don't have any envelopes nearby, sorry. Oh, wait, yeah, I do. They'd pour some wax on the envelope here. And if that seal, and it would seal it shut, and if the seal is broken, you would then know that obviously somebody tampered with the letter. Okay, so the seal has then been reduced. Instead of wax, they just have a stamp with it. So you might be thinking, okay, well, that's a share. All right, but it says it promises to pay the holder of that document a fixed rate of interest. Shareholders get paid dividends. They do not get paid interest. Interest is paid on loans. This type of loan is called a debenture. Right? So a debenture is a special type of loan. Well, it is a loan that a company company takes. But how they do it, instead of going to the bank and asking the bank to borrow money on the bank's terms, as in the bank sets the interest rate, the bank tells us when to pay back, the company says, here what, I want to borrow money and I'm going to borrow it at 10% and I'm going to pay you back every 6 months, every 3 months, every month, once a year, whatever the case is. So a debenture is the name given to that financial instrument. Okay, going on to number 5. So Space is Limited issues 1,000 10% $100 debentures 2015 to 2020 to raise additional funds to finance projects. What is the meaning of the 10% and the $100? Okay, so Space is Limited issues 1,000, that's how many? So 1,000 is the number of debentures. 10% is the interest rate. $100 debentures. So you can call it the price of the debenture or the value. You could even call it the par value. And this 2015 to 2020, that tells us that's called the tenor of the loan. When it's issued, 2015, and when the total, everything has to be paid back by 2020. So we're looking for interest rate and par value or price. So discount rate and price purchase, so not discount rate, that's something else. The interest rate and the price of each of the debentures being issued. I'm okay with that. This one says dividend rate, so we know that's a giveaway. That dividends are for shares, not for debentures. These items have no meaning. All right. Your potential is unlimited. Issues 5,000, 12%, 200 debentures, 2018 to 2023 to raise funds to finance a project. What is the meaning of the 5,000 and how much money would the company raise if the issue is fully subscribed? Okay, so it issues 5,000, 12%, $200 debentures. 5,000 is the number of debentures. So the number of debentures, right? And if they issue 5,200 debentures, it means the total amount of money being raised is 5,000 by 200, which I believe is $1 million. Yes. So we're looking for $1 million and the number of debentures. Okay, so I know some of y'all are screaming at me, sir, what about the 12%? You didn't multiply by the 12%. Listen, 12% is the interest rate. The interest is the expense on the loan. The loan is the debenture, right? When you are issuing the debenture, the 12% has no relevance to how much money is coming in. And I don't want to get into all talk about demand and supply interest rates. No. It does not affect the calculation of the money being raised. All right? So just understand that the 12% plays no part of the calculation when you are now issuing the shares. When you are paying the interest, yes, you have to calculate the interest on the debentures. By all means, go ahead then. Pay attention. That's a very important point there. Scrolling down and across to number 7. SK Limited, wink, wink, can legally issue the following shares. 1 million ordinary shares with a par value of $1 and 50,000, 12%, $10 preference shares. The 12% here is not an interest rate, it is a dividend rate. Preference shareholders get a fixed rate of dividend and are paid before ordinary shareholders. $10 is the par value of the preference shares. So the shares were offered for sale to the public. 90% of the ordinary shares and half of the preference shares were purchased. And I hear the gears turning in people's brains. I hear the calculators going clack, 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 clack. And you haven't read the question yet. What is SK's? Okay, what is the SK's? What is SK's authorized share capital? Authorized share capital is the total number of shares that the company is legally permitted to issue, the legal maximum number of shares. 1 million ordinary shares at $1, which is 1 million in total, and 50,000 $10 preference shares, which is 500,000. And just like in the previous question that I was talking about with the percentage, that was the interest rate for the debentures. This is the dividend rate for the preference shares, and it plays no part in the calculation of the share capital. Well, the amount being raised. It is only relevant when you are paying dividends. And that's a mistake I see every year and for the past several years. And it baffles me, but once again, everything in due course. Anyhow, so 1 million plus 500,000 is 1,500,000. So let's go down to number 8. Yost Inc. was initially incorporated as a private limited company. After some time, the owners realized that they could raise much more capital if they sold shares on the stock exchange. If the company were to sell its shares on the stock exchange, what type of company would it be? Well, if they were private and they weren't able to sell on the stock exchange, and now they want to and are selling their shares on the stock exchange, they are a public limited company. Come on, man, Philip. Cool. Scrolling down to number 9. So that was Yost Inc. This is Humost Inc. Earned a net income before appropriation of $150,000. The directors declared an ordinary dividend totaling $25,000, a preference dividend of $15,000, and will transfer $50,000 to the general reserve. Retained earnings at the start of the year were $100,000. What is the amount of retained earnings carried forward to the following year? Retained earnings are the profits left over after all appropriations have been made. So we have a net income before appropriation of $150,000. The ordinary dividend, preference dividend transfers to reserves. If we add up everything here, we're going to get $90,000. We're going to subtract that from the 150. 150 minus 90 is 60. And you have a retained earnings reserve at the start of the year of $100,000 brought forward. So now you have an extra 60 to add to that 100, which means you're going to have 160. Let's scroll back up and scroll across to number 10. I Need Company Limited issued share capital as per the details in the table below. So we have types of shares, ordinary and preference. Number of shares, 250 and 100,000 respectively. Par value, 4 and 10 respectively. If the issue was fully subscribed, what is the value of the issued share capital? So how much money would they make if they issued everything here and it was fully subscribed? Fully subscribed means everything was bought. So you sold 250,000 ordinary shares at $4 each. That's $1 million. And 100,000 shares at $10 each. Well, isn't that also $1 million? So $1 million plus $1 million is $2 million. Number 11. The maximum number of shares that a company is legally allowed to issue is referred to, well, we talked about that a bit earlier, right? That's authorized share capital. Authorized share capital. The legal maximum number of shares. The par value of a company's ordinary shares is $1. But the shares were issued for $5 each. What is the extra $4 above the par value of the shares referred to as? The share value is 100. Now, it's not profit in this case because profit is only for income and expenditure, revenue and expenditure. This is share capital. And the excess is known as the share premium. I've also heard it referred to as paid in capital in excess of par value, but I'm going to stick with share premium for now. Let's scroll down to number 13. So, Spigoogie Tax Incorporated issued the following shares. So, we have ordinary 500 at 2, preference 12 at 100, that's $5 per share. Ooh, what are the journal entries to record this? So, you know you all on journal entries. So, first of all, when we issue shares, if it's fully subscribed, money is coming into the bank account. So, we're going to be looking for a debit to bank. But if you look at every single option here, the debits and credits are all the same. So this is not necessarily an easy one, as easy as some of the others where you only had one possibly correct answer. So we now need to look at the values and where they're going. So ordinary shares, 500 at 2, as $1 million, the ordinary share capital. And preference shares, 100,000 by 5, that's $500,000. So 1 million from ordinary plus $500,000 from preference, that's 1.5 million. So we're looking for 1.5 million to bank, there you go, and it's accompanied by $1 million to ordinary and $500,000 to preference. Let's go again. So what is the annual dividend due on 100,000, 5%, $10 preference shares, 2016 to 2026? They want the dividend rate, which is this. 5%, but 5% of what? The par value. What's the par value? Well, $10, but that's per share. How many shares they have? 100,000. So 10 by 100,000 is $1 million. 5% of 1 million is 50,000, which is option D. So once again, we multiply the 5%, the dividend rate, by the total par value in issue, which is number of shares by the par value per share. Cool. Number 15. If there are 500,000 $10 ordinary shares in issue, and the board of directors has declared a dividend of $2 per ordinary share, how much money will be paid out in total in respect of ordinary dividends? This is a per share dividend. So they're paying $2 per share. So the par value here is irrelevant. The number of shares is what you have to watch, which is 500,000. So they're paying $2 per share on 500,000 shares, which is $1 million in total. Always be careful with your dividend calculations. Figure out if it's based on the number of shares or the par value. Preference shares are almost always based on par value. Ordinary dividends are usually based on a per share basis. But there are times, including in this paper, where you are given a percentage, which means it's a percentage of par value. All right, number 16. The journal entry that is made when ordinary dividends are declared. So when the board of directors decides that it's going to pay a dividend and they declare it, then they now have an obligation to pay that dividend. And until that dividend is paid, it is owed to the shareholders, which means it is a liability, and usually it is a current liability. And in this case, the liability is increasing. The directors have now said, hey, we're going to pay you this much. And the shareholders are like, really? Bring it. I'm ready for my money. And like, oh, we're not ready to pay yet. Oh, so you owe me money? Good. So you have a liability that is now coming into existence. So we have to credit the dividend payable. And there's only, oh, hold on, it says dividend payable, but it says debit. That's not a good thing. Here, ordinary dividend payable, debit appropriation. So the debit to the appropriation will decrease the profit in the appropriation account, and the credit to ordinary dividend payable will show the bringing into existence of the current liability. So this is the answer here. Debit appropriation, credit ordinary dividend payable. 17. What is the amount of money raised if 250,000 10% $4 debentures are issued and fully subscribed? So 2019 to 2024, that is the tenor of the loan, the number of years for which the money will be outstanding. Now they want how much money is raised. How many debentures? 250. What's the price per debenture? $4. What's this 10%? The interest rate. Is it relevant to the issue and raising the issuing of the debentures and the money coming in? No. So 250 by 4 is $1 million. If anybody know where that's from, comment and let me know. I know either you're kind of old and watching this video, or you have good taste in movies. Right, what is the dollar amount of interest due on 250,000 10% $4 debentures? Okay, so this is same exact information. Now they're asking what is the dividend, what is the interest due, sorry. So now we have to multiply that 10% by the 1 million. So you're multiplying 10% by 250 by 4. So 10% of $1 million is $100,000. Nice. Okay, guys, we have a couple more questions. All right, so number 19. So Invisible Inc. issued 100,000 ordinary shares with a par value of $1 per share at a price of $3. What is the journal entry to record this if the issue was fully subscribed? So we have a par value of $1, but an issue price of $3. So remember a few questions ago we talked about share premium, the excess above the par value for which the share is sold. So if you sell a share for 3 and its par is 1, you're getting an extra $2 per share, and that is the amount of the share premium. Now, when you issue shares and it's fully subscribed, money is coming into bank. So we're looking for a debit to bank. All of these have debits to bank. Ordinary share capital is increasing. Capital is increasing, which means we need a credit. And we credit ordinary share capital with its par value. So we're selling 100,000 shares at $1 each. That's 100,000 going into ordinary share capital. So that's here and here. But how much is going to bank? We sold 100,000 shares for $3 each. which is $300,000, which means that this is the answer here. So how do we explain the rest of it? Well, once again, $100,000 went into ordinary share capital because that was the par value of the ordinary shares being issued. The excess above the par value is the premium, and that goes to the share premium account. Now, it can be called different names. It could be called share premium on ordinary shares, paid in capital in excess of par on ordinary share capital, all sorts of things. But right, debit to bank, credit to ordinary share capital for the par value, credit share premium for the premium. All right, and a couple of short questions. Which of the following items would appear in the appropriation account of a company? Directors' remuneration. Remuneration is a fancy word for salary for directors. So that goes in the expense section. As does debenture interest. Interest on capital is a partnership appropriation item. Dividends. Which of the following would not appear in the income statement of a company? Remuneration would. Debenture interest would. Dividends would not. That goes in the appropriation section. Depreciation is a relatively common expense, so it would go in the expense section. Okay guys, so that's it for this video. I'm gonna cut my outro short today, so I'm not gonna have the usual saying and stuff. If you guys have any questions, please put them in the comment section below. If you guys want to check out more videos, click on that one if you want to go to the whole playlist. Click on that one if you want to go to the company's playlist. And of course, don't forget to subscribe. Like, share, and subscribe, guys. Until next time, don't forget, if what you're doing isn't working, then adapt. Because change is the only constant. I'll see you.